So we all use banks, right? But how many of us really know how they make their money? It's definitely not just about big vaults and friendly tellers. Today, we're going to pull back the curtain and break down the real business model of banking. Yeah, let's really get into this. You trust them with your hard-earned cash. You see their logo everywhere. But the way they actually turn a profit is this really fascinating mix of old-school lending and some pretty complex modern finance. All right, here's how we're going to break it all down. First, we'll look at their original super old-school business model. Then, we'll dive into the power of fees. All those little charges you see. After that, we'll take a peek at their high-stakes Wall Street operations. And finally, we'll tie it all together and show you why understanding all this can actually help you manage your own money way better. So at its absolute heart, the business of banking is built on this one surprisingly simple idea. It's been around for centuries, and it's all about being the ultimate middleman for money. And it's really as simple as it looks on screen. You put your money in the bank, right? Well, in doing that, you're basically giving them capital. They take that money and lend it out to someone else for a mortgage, a car loan, whatever. But they charge that person a much higher interest rate than they're paying you. That gap, that difference, that's their fundamental profit. So this gap, this profit, it actually has a fancy name in the industry, net interest margin, or NIM for short. You can just think of it as the profit spread. It's really the core measurement of a bank's health, and it shows exactly how good they are at using our deposits to make money. This is the real engine room of the bank. In this chart, it just makes it crystal clear. Let's say the bank pays you a measly 1% on your savings. Then they turn around and lend that exact same money to someone else for a car loan at 6%. Boom. They've just created a 5% profit spread out of thin air. Now multiply that by millions of customers and billions of dollars, you start to see just how powerful this model is. Okay, but as you've probably guessed from your own bank statements, that interest spread is only where the story begins. Banks have become absolute masters at generating revenue in other ways, and a huge part of that is something called non-interest income. Yeah, I'm willing to bet a bunch of these look painfully familiar, right? From monthly account fees to those brutal overdraft penalties. None of this is by accident. Every single fee is a carefully designed revenue stream that gives the bank a steady, predictable flow of cash that has nothing to do with their lending business. And this quote from Centellus Axiom really hits the nail on the head. See, when the economy gets a little shaky or interest rates are super low, that profit spread we just talked about can get squeezed pretty tight. Fee income, though, that's way more stable. It's like a financial safety net that helps keep the bank making money no matter what the market is doing. All right, let's talk about the third pillar of bank profits. And this is where the numbers get absolutely massive. For the biggest banks in the world, the real high-stakes game isn't played at your local branch. It's played on Wall Street in the world of capital markets. And it's super important to get this difference. Commercial banking, that's for you and me. Our checking accounts, our mortgages. Investment banking, that's a whole different league. They're dealing with giant corporations, institutions, even governments, helping them do things like raise billions of dollars or make huge strategic deals. And these services generate enormous fees. Think about it. When a huge tech company wants to buy another one, an investment bank is in the middle, advising them and taking a fee that could be hundreds of millions of dollars. Or when a new company wants to go public with an IPO, the investment bank manages the whole thing and gets a nice percentage of all the money raised. It is a very, very high-reward business. Okay, so we've got the lending spread, we've got the fees, and we've got the big Wall Street deals. So what does that look like when you put it all together for a typical modern bank? This chart really paints the picture perfectly. For most of the big diversified banks, that original lending model, the net interest income, is still king. It's the biggest piece of the pie, making up around 60% of their revenue. But just look at how significant those other pieces are. Fees make up a solid quarter of their income, and those riskier capital markets activities kick in another 15%. All three are absolutely vital to their success. So why are we going through all this? Well, understanding how your bank makes its money isn't just trivia. Knowing how they operate can actually make you a way smarter customer. I mean, what does this actually mean for your wallet? Simple. When you know their playbook, you can navigate your relationship with them so much better. You start to see their products not just as helpful services, but as carefully crafted pieces of a much bigger business strategy. So let's boil it all down. What should you take away from this?
that savings account you have, to the bank, that's cheap raw material for their business. Those overdraft fees, that's not just a penalty, that's a stable profit center. Now, this doesn't make banks evil, it just makes them a business. And once you really get that, you gain the power to shop around for better rates, to question fees, and to make much smarter choices with your money.